Great. I see that we are back. So again, good morning, good afternoon, and good evening to all of you joining us today. My name is Georgios Padzikas, Head of Engagement and Partnerships at Blockchain for Europe. We are delighted to welcome you to the second webinar organized by the Blockchain for Europe in collaboration with our partner, the Global Impact Fintech Forum, GIFT. Today, we will delve into the topic of digital assets regulation in the Trump era, exploring whether it represents a boom or a bust. This discussion will focus on the opportunities and challenges that may arise from other jurisdictions in response to US initiatives, as well as ongoing global initiatives in this domain. Specifically, we will discuss US policy changes and digital assets regulation and cross-border ripple effects and jurisdictional responses. So before we start with the discussions, let me say a few words about us, starting with our partner, the Global Impact Fintech Forum, GIFT, is a non-profit organization, a think tank that collaborates with global agencies, universities, and industry experts to produce insights on topics such as blockchain, AI, digital financial inclusion, and regulatory technology. On behalf of Blockchain for Europe, we are a Brussels-based association representing the digital assets industry with over 30 members. We work with policymakers, academics, and companies to develop a comprehensive regulatory framework in Europe to promote blockchain-based innovation. One of our core missions is education. We aim to educate our audience, including the regulators who may not be fully familiar with the blockchain technology, decentralization, and related matters. This webinar is designed to fulfill this mission by engaging stakeholders and providing valuable insights into the ongoing initiatives concerning the digital assets world. With that said, I would like to thank our distinguished speakers for participating in our webinar and briefly introduce them. Unfortunately, we had some last-minute cancellations, so probably we might conclude with this session a bit earlier. That's what we need to inform you on our behalf. I will start with a professor and with our moderator, the Professor Malik Kotadia, founding chairman of the Global Impact Fintech Forum, Mr. Peter Kerstens, advisor on technological innovations and cybersecurity of the European Commission and the Directorate General for Financial Services and the Savings and Investments Union, Ms. Maha Al-Saadi, head of regulatory affairs at Qatar Financial Center Authority, and Professor Douglas Arner, a professor in law at the University of Hong Kong, Mr. Elito Villanueva, chairman of the Fintech Alliance of Philippines and executive vice president and chief innovations and inclusion officer of RCBC, and Mr. Chen Arad, a co-founder and chief of search experience optimization at Solidus Lab, member and also member of the Global Markets Advisory Committee of the Commodity Futures Trading Commission, CFTC, in the US. So yeah, before I will pass the floor to you, Malik, to start the conversation. Thank you.
Thank you very much, Georgios. And on behalf of the GIFT Forum, I am delighted to welcome everyone today. Good morning, good afternoon, good evening for us, me, and even later evening for Professor Arner, sitting in Japan. We are delighted that we are doing this second joint webinar with our partners, Blockchain for Europe, who are both like-minded in terms of objectives as well as their focus on knowledge sharing, which is what we do a lot as well. So I'm actually very thrilled that today on the panel we have experts, policymakers, people in the trenches from pretty much all regions of the world. So I think it's as global as can be, and therefore it's as the moderator, it's exciting for me to be able to draw into this pool of knowledge. Time always will be limited with such a panel, but we'll do our best to maybe get relevant information. Of course, the topic is about the new administration in the USA, and we've all seen a flurry of activity that has happened. So let me start with that, and we'll go around the table and hear from different regions on what are the ramifications, what's the impact of these announcements, these policies, these changes, and how are various regions, jurisdictions, as well as ecosystems responding to it. So let me start with Chen, who's sitting right where all the action is in Washington, DC. Pleasure, Chen. This is the first time I've done various panels with many of the panelists here, but first time with you, so my pleasure. Uh, it's been about 100 days. We just completed 100 days of the Trump administration. And for those of you who would have probably seen the headline, The Economist calls these 100 days revolutionary. And it is actually on the cover described him as a revolutionary president out to change many key aspects. One of them, and of course relevant for us, is the USA's stance on crypto and digital assets, which was hitherto largely seen as unfriendly, not very clear, ambiguous by the global community. I think many of us who've been in this ecosystem and space for a while have heard these things, that there was always a perceived lack of regulatory clarity. It was not very friendly, and businesses have been choosing other more friendly jurisdictions, whether it is Malta or UAE or even Singapore in cases, as well as not too much clarity and slow progress on the USD stablecoin and the CBDC that was supposedly announced and now scrapped. These are all factors. And then we saw Trump come into office and the initial executive order. And since then, various announcements, a lot of developments. We've seen the mood change. We've seen Bitcoin shooting up immediately after that. And much seems to be happening. So let's hear it from our expert from the trenches and someone who's been engaging with both policymakers and ecosystem players sitting in DC. Can you share more on the Trump administration's policies around crypto in general, and maybe a little more focused on stable coins, things like yield-bearing stable coins, what it means for the US dollar as such, given how we've seen the US dollar significantly decline over the last few weeks to below 100. The Dixie came to below 100, as well as maybe if you have a view on the potential next steps in terms of what you see likely in the next 100 days, because I think the announcements are done and dusted. Now we'll see the action likely in the next 100 days. So over to you, Chen.
Thank you so much, Malik, and it's a real pleasure to be here. I'm very happy to do this for the first time and join your cool kids club of experts globally. I'm trying to think how to keep it succinct, considering there's so much that happened and you've asked quite a few questions. But I'll start by saying that, as you mentioned, I am in Washington right now because of the 100-day mark, going to Congress to continue with a series of meetings, continue meeting with policymakers, both in the Senate and the House, and their teams, as they are working on getting the stablecoin Genius Act across the line and finalized, signed, and of course already working and thinking about the next piece of legislation, which is going to be very important, which is going to be focused on market structure. But starting with the premise, I think you painted the picture quite well. To say that there was disappointment by the digital asset industry from the last administration would be an understatement. There was, deep frustration, and it has to do with a lot of the reasons you mentioned. It didn't feel like there was a real effort by the executive branch, by the White House, to lead to regulatory clarity. There were some efforts in Congress, but Congress was with the Democratic leadership. There were some successes. They didn't lead to clarity. But perhaps one of the things that was most frustrating for the industry, and you alluded to it, but I'll just emphasize it, was what a lot of people here term regulation by enforcement. And recently, the Department of Justice in the U.S. termed regulation by prosecution. Essentially, in the absence of clarity, when there are no federal laws regarding crypto, there are only clear licensing frameworks in a few states, including, of course, New York, which was one of the earliest to introduce it. There were a lot of prosecutions against digital asset firms. And without, of course, making a judgment on, the legality or how many of them were right, how many of them were wrong, there was just a sense that even platforms that were really trying to be compliant were, targeted by prosecution for the sake of headlines, for the sake of showing that something is done against crypto after FTX. But generally speaking, I think Well, the election results were not only about crypto, they were about a lot of items. There's no question that digital assets, crypto played a role. We have data that shows that 1 in 7 likely voters before the election said that crypto is an important issue for them. And it made a difference. And, when you walk in Congress now, when you meet with both Republicans and Democrats, you can really feel the impact, and the digital assets is a central issue. Now, that has translated into a pretty remarkable 100 days marked yesterday. And there's too much to list everything that happened. But if I'll summarize all of it, I think the first 100 days were remarkable, were very important. But a lot of how important they are going to be tested in the second 100 days. And let me explain why. I mean, right as Congress switched leaderships and the White House came into power, literally within days, the Trump administration has used its executive authority where it could to really reverse and set the agenda in a different direction. There's a long list of things that happened. They include, on the executive side, of course, appointments of folks who have a lot of experience with crypto. And it is important to say, though, by the way, that when Gary Gensler, who left and was considered sort of an antagonist of the industry, when he was appointed, he also had a lot of experience with blockchain. So it's important to, when you think about appointments, to remember that people sometimes change when they take the role. It also depends a lot on the political environment. But appointing Paul Atkins, who was a former SEC commissioner, to the chair of the SEC after he worked for years advising crypto firms on how to be compliant. Appointing Caroline Pham as acting commissioner, someone who's been very engaged with the digital assets, and then Brian Quintens, who was the chief regulatory officer of A16Z and a former CFTC commissioner, to the chair of the CFTC, are all really, really strong signals. That was, as that was happening, literally within a week of Trump, within 2 weeks of Trump taking over the White House, he signed an executive order, which is, in my humble opinion, very remarkable. It's remarkable for a lot of reasons. It sets a very clear timeline, the deadline of which is June, for a working group that includes the new leadership of the CFTC, SEC, a lot of other members of his cabinet, to put forward a proposal by June for a regulatory framework. Now, it's important to say that that is something the executive branch can do regardless of legislation. Legislation is much more complex, also in a lot of ways much more long-lasting. But the fact that there is a timeline, and the fact that the timeline is for these specific personas in this particular political atmosphere to create clarity on a federal level is remarkable. And in my opinion, means that we're going to see some degree of federal clarity on how digital assets should be licensed, what they need to do to be compliant, regardless of legislation. And I'll finish by talking about the legislative piece. And I'm sorry, I know I'm taking a lot of time, so I'll try to make it as quick as possible. But I'll just mention also on the executive side, we've seen some smaller actions that are really significant. So the Fed and the OCC, the Fed is the central bank, of course, the OCC is another bank regulator, with rescinding decisions that they made it harder for banks to work with crypto platforms. The fact that there was a rescinding of an IRS policy that made taxation regarding DeFi activity much more complicated. All of these are things that the White House took and are action, and they have immediate impact in terms of inviting more innovation, inviting more participation in digital assets. On the legislative side, two big items, and stablecoins is the more immediate one. One of them is a stablecoin bill, which was introduced originally as an act called the Genius Act in the Senate by Senator Bill Hagerty. Essentially, it does two major things and a lot of other things. But the two major things is that it forces the Fed, the U.S. central bank, to create a licensing framework for regulated banks, FDIC insured banks, to issue stablecoins. It also assigns the OCC, the other regulator of banks in the U.S. and currency, to issue license. It allows it to issue licensing for non-bank issuers. So in practice, once that is signed, and after the regulators put in place the applicable licensing framework, banks in America are going to be allowed to issue stablecoins, and of course also to accept stablecoins. It's massive. There are also a lot of other important pieces in it regarding, state alignment on state level, There's a bar of $10 billion under which a stablecoin issuer can be licensed under state regulators and above it on a federal level. Now, following the Senate bill, a bill was also passed called the Stable Act in Congress. And now we're in a process of what's called reconciliation. That's a big part of why I'm here today. There's a lot of industry folks who are meeting to just emphasize how important it is to get it through. I won't go too much into more details around why is it important for the US, but obviously it has massive geopolitical ramifications for demand to the dollar and usage of the dollar, which is really important obviously for the United States. But we should be seeing it signed according to everything I'm hearing, according to news reports, and just according to the Prof soon. Another piece of really important legislation, and I'll speak about it more briefly, is the market structure bill. That one is supposed to essentially answer the very long debated question of which, I wouldn't say what's a security, what's a commodity necessarily when it comes to digital assets, but more which regulator regulates each. The SEC, which of course regulates securities, the CFTC regulates commodities. So creating clear guidelines on what those are, and then also creating a licensing framework that would allow providing these services in a regulated, clearly legal way on a federal level. It should invite a lot of Wall Street, a lot of FINRA, that's the self-regulatory organization for the brokerage industry in the US, FINRA-regulated brokers to offer digital assets, and should play a very important role. I should say, as the last comment, that there's much more challenge, it seems, there in getting to an agreement between the industry and regulators. We've seen a little bit of this disagreement in regards to stablecoins when it came to yield-bearing stablecoins, where a lot of industry leaders called for the law to allow yield-bearing stablecoins. And the Republican leadership actually put a very clear line in the sand and said that's a topic for a later date. That's a secondary market issue, not an issuance-related issue, which some could interpret as the beginning of the end of the honeymoon period and the fact that there are limits. The market structure bill is still being debated. Many believe it will be based on FIT 21, which was a bill that actually got 70 Democrats as part of a majority in Congress last year. But it's unclear, and a lot of the differences there are more around what's the definition of decentralization, how accountable are DeFi protocols, stuff like that, in addition, of course, to the question of what falls under the SEC, what falls under the CFTC. I was just in a meeting with the SEC task force led by Commissioner Hester Pierce last week. They seem to be working really, really hard on trying to provide that clarity. And as I mentioned, while there's still hope, there's a lot of hope that the market structure bill will also pass by August, while the stablecoin bill should pass in the next few weeks, couple of months. It's also, regardless of the legislation, I believe there's going to be some degree of federal clarity because the agencies have been working on it so hard and are due to present some form of regulatory framework by June. So I'll apologize for taking so long. I tried to keep it succinct, but I hope it serves as a foundation for the conversation today, Malik.
Thank you, Chen. And I think if anybody could do an excellent job of summarizing so many and encapsulating so many points in 10 to 12 minutes, I think you've hit the nail on the head. So thank you for that. A lot of things that you shared, and I have quite a few follow-up questions, but I'll perhaps reserve them for if we get time for a second round, because let me then now go to Peter. Hi, Peter. Again, this is the first time I'm having the pleasure of sharing the stage with you. So from USA to Europe, on the other side of the Atlantic, clearly we've seen, I don't want to use the term some emerging bad blood, but there is some dissonance in this relationship at a macro level. And given these announcements zeroing down on crypto and digital assets, please share your perspectives from Europe on whether these new policies are seen as a boon or as a bust for the region. And how are they perceived by the ecosystem in the EU, whether it's the industry players, whether it's the central banks, or whether it is the ECB itself? And, again, given this move in many parts of the world, which we'll touch upon hopefully later on de-dollarization, what does it mean for the role of USD and trade between the partners as well as stable coins? Is this an opportunity for Europe, at least on one front, to maybe continue its decoupling from the traditional relationship with the US? How do you view it? Over to you.
Well, thank you very much. That are a lot of questions, and some of these questions are politically very loaded, but I'll try my best.
You can answer, feel free to answer whatever you feel to.
Yeah.
I didn't mean to put anybody on the spot, but these are just some questions which I think everybody is trying to come to terms with and grappling with.
And they're very good questions. So on the one hand, from a European perspective, or from the perspective where I sit, and I just speak for myself, the developments in the US have been long awaited. But we also have a bit of a feeling of Groundhog Day. So the debate which is currently unfolding in the US, both on the stablecoin bill, but also on the market structure bill, is the European Union went through this and to all the permutations of solutions that are possible a couple of years ago. So we see this being relitigated. Of course, the ecosystem has evolved a bit more. So when we did our legislation a couple of years ago, the discussion on decentralized finance wasn't really very deep, and we just sort of left it aside. Whereas now there's much more focus on, well, what is decentralization and can you really capture it in regulation, and so on. But I would expect that when everything is done and dusted, both on the stablecoin legislation, but also on the market structure legislation, that the United States will not end up too far from where the European Union landed with the MiCA regulation. Some people will like this, some people will dislike this. our MiCA framework is by no means perfect, but it is a typical political compromise between various perspectives. And these perspectives, which vary across member states and between the parliament and member states, that variation is also seen in the US. But I do think that both in panels like this, but in the ecosystem as well, too much attention is being paid to legislative developments. Because if you look at it, the United States so far hasn't changed a single letter of the rules. No, that's not true. They changed the broker rule, but apart from the broker rule, no regulation has changed. The only thing that has changed is the attitude of the policymakers and the attitude of the regulator. And that has a huge impact, an enormous impact. And so rather than focusing on what precisely the legislation says, it's much more important that the regulator, the supervisor, has an enabling and a positive attitude towards the ecosystem and is willing to engage with the ecosystem to see where it leads, because we are not very good at predicting the future. If I was good at predicting the future, I would be having a different job. But we want to accompany whatever the future is in unfolding in a positive way. Now, the US developments have a very peculiar effect on the EU. And I'll say something which is politically incorrect, but that doesn't mean it's factually incorrect, it's politically incorrect, is that because the Trump administration seems to be very in favor and very pro-crypto, unlike Trump 1, where he was rather agnostic and sort of rather anti, because the Trump 2 administration is crypto positive, there seems to be an undercurrent in Europe that therefore we must be much more skeptical and we must be anti-crypto. And I think this would be very damaging, because while there may be many things people may want to disagree with the US president, when it comes to his crypto stance, I think it's actually quite positive. And it's not because he is in favor that we therefore should start relitigating the MiCA regulation, reopening it, or calling it into question. But we must move forward in looking also at tokenization of financial assets, real world assets, and so on, where really, in my view, the future of blockchain technology in financial markets lies. And once that will scale up, everything which is happening in crypto markets will be a sideshow, because these crypto markets currently at close to 3 trillion market cap are only a fraction of the size of what financial markets are. And that's where the potential is. And personally, I am much more interested to see what the United States will do on tokenization of financial assets, rather than what they are going to do on stable coins or on the market structure bill for for crypto assets, because I think that will really be very, very determinant for what other jurisdictions will be doing, including ourselves, because of course we are very engaged in building this savings and investment union, used to be called the Capital Markets Union. And I personally believe that tokenization, digitalization has a great future to play in that space. But we can't be complacent and say, oh, well, because the EU has the most developed regulatory framework so far, both for crypto assets, but also for what we call the DLT pilot regime, the testing of DLT technology in financial markets, that therefore these financial markets, tokenized financial markets, will develop in the European Union. If I see what's happening in the US, if I see what's happening in the Middle East, if I see what's happening in Southeast Asia, I think there is a very significant risk that if the EU does not pay attention to these developments and does not step up to the challenge, that we will become a bit of a flyover zone for tokenized financial markets, where big capital from the US will move across the globe, and capital from Asia and the Middle East will move across the globe and just skip the EU. And therefore, I think we must take the developments in the United States as an encouragement to go a step further. Sort of, yes, we'll let them catch up on what is covered by the MiCA regulation in crypto assets, and they'll get their stablecoin bill. They'll probably get a market structure bill of sorts. Part of that debate is very typical US. It's between CFTC and SEC, which no other jurisdictions have such a distinction in securities and commodities regulators. So the entire debate is fairly sterile for us. It doesn't really matter to us. But once these regulators start also looking at tokenization of their traditional constituencies, we will see major global movements, because once these assets are tokenized, and that may be under national jurisdictional law, if these tokens are traded and listed, if you wish, and inscribed in global ledgers, they become transferable and tradable all over the world. And we will see, for the first time, genuinely global capital markets developing, where investors in Southeast Asia, if they wish, can buy tokens representing assets in the US without the need for intermediaries. There will be intermediaries, and if they want to avail of them, fine. But if you want to seek exposure directly into what could be rather exotic securities from other jurisdictions, tokenization makes that possible. And I think that's also very exciting for deepening capital markets. So I think that the US, to sum up, is a bit late to the game in getting its regulatory framework in place, but they'll get there. As Churchill said, the United States will always end up doing the right thing after having tried everything else. But we must be very vigilant and not in a negative way, but take encouragement from what they are going to do about tokenization of financial instruments. And I hope that that will serve as a catalyst for the EU and other jurisdictions to also sort of think about the potential this technology has, and to challenge certain, what I'd say, conventions and taboos, where some people say, well, in a financial market, you have certain players, and the role of these players must be preserved, must be guaranteed, even though the technology sometimes obviates the need to have certain functions fulfilled. And because these are large financial institutions that fulfill these roles, very vested interests, this is a highly, highly political debate. But I think that if we do not engage in that debate, the technology is so powerful and so empowering that it will just develop, and other people will just develop it outside of the financial market infrastructure into a new generation of what's called shadow banking, which will turn the current shadow banking into something fairly insignificant if you see what can happen with technology-based capital markets. So that's, I think, where I want to leave it, because I think that the Genius Bill and the Stable Act and the Stable Act and the Genius Act and the Market Structure Act, they attract an awful lot of attention. But what really people should be focusing on is, what are the regulators going to do with their own regulatory authority? Because Congress doesn't need to do very much. The SEC and the CFTC can enable a lot based on their existing powers. Same for the banking regulators, the federal banking regulators in the US. Based on their existing jurisdiction, if they change their attitude, they can really empower the crypto ecosystem or the blockchain ecosystem. And that is something for the entire world to watch. Thank you.
Thank you, Peter. You've covered a lot of points. Again, I have so many questions swirling in my head, but perhaps we'll not be able to address them on this webinar. And thank you also for your candor on the politically incorrect perspectives. Appreciate it. If I were to distill what we've heard from both our initial speakers, Chen and Peter, I think one thing that was playing in my head when Chen was speaking is, I think the US at least is giving signals that it is trying to move away from what he called governance by prosecution, and some of in the industry might actually see governance by persecution to governance by engagement and governance by clarity. So I think that's, as Peter said, signaling is very positive and very important. So the signaling is in the right direction. And the other thing which really struck me with what Peter said is he was harping quite a bit on real world digital assets. And I think all of us here are in absolute support of that, though now it's my turn to make a politically incorrect statement. Some in the ecosystem may not like what I'm going to say, but I think this industry has one problem, that it has a habit of conjuring up new buzzwords every year and then sometimes moving on and forgetting and not going through with follow through. 2020 and 2021 were the years of NFT. Then 2022 was supposed to be the year of DeFi. Then we heard this whole focus moving once we saw the collapse of the DeFi ecosystems and some exchanges. Then everybody was talking about tokenization of real world assets and how trillions in value will be unlocked. I, for one, am patiently waiting, and I hope this happens. But again, the industry will have to move beyond cool sounding jargons and slogans to actually delivering on things. Chen, you were trying to say you had a point to make. Please go ahead.
I already feel like I took way too much airtime, but just I think an important point to echo Peter's point. And again, I kept on going back to this idea that, like, regardless of legislation, we'll likely see federal clarity because the regulators have the backing and impetus of the White House. And so a specific example that I think is very relevant is that you mentioned, Malik, earlier, I'm a very proud member of the CFTC's Global Markets Advisory Committee, which last year recommended that the CFTC would start allowing using DLT and blockchain as a system of record for commodities trading, which of course is, a step towards tokenization. So just to emphasize again that, and the CFTC ultimately commissioned right before the election, when the momentum, which was clear where the momentum was going politically, voted to allow it. And I was just at the Futures Industry Association conference last week, and it's incredible to see how much it's driving innovation and impetus among very veteran organizations to start thinking more seriously about tokenization. So just to echo Peter's point that the regulators have a huge amount of power. The concern with regulatory-driven versus legislative-driven policy is, of course, that the next administration can change it. But ultimately, you see here an opportunity that the regulator gave, regardless of legislation, on tokenization for businesses to build and innovate with more confidence. And ultimately, if there's enough demand to it, there's no democratic or any administration that would come afterwards and would change it, right? So just wanted to mention that as a specific example on tokenization. I agree with Peter that it's really important. I agree, of course, that there's sometimes a bit of an over-focus on the political and legislative game that really is just supposed to guide where regulators end up taking the actual licensing framework and regulations.
Thank you. So from the partners in the Atlantic, we move to Asia, this part of the world. And I go to my friend, Professor Arner, and I always ask him these questions in which I find them quite relevant and interesting and important, and sometimes often missed out by Western commentators. So let's turn to the expert on China and the Greater China region, Professor Arner. When we talk about the all the impacts and announcements of Trump administration policies, we cannot not touch upon the elephant in the room, which is basically all this flurry of activity around, and of course sometimes confusing like hell activity on tariffs and China. And we've also seen what was the kind of attitude of the Trump administration, the first Trump administration towards China. So how do you see the impact of the tariff war on the global South? So I'm going to expand it a little more, not just China, but talk about the global South if you want to, but of course with a focus on China. And I'm going to ask you two pointed questions. What does it mean for, one, the digital yuan, which I think all of us would agree has been perhaps the gold standard for CBDCs, not just the innovator, but also the gold standard, and how they've partnered with private industry players like Alipay and WeChat Pay. So that's the first part. And when we talk about global South and China being perhaps the most important, or one of the most important components of this, we're talking about the BRICS and the BRICS currency and trade settlement system, which again sinks in with the larger geopolitical developments and the whole move towards de-dollarization. What would be the role of digital assets and blockchain and DLT on this, if any? So the first is on focusing on China and the digital yuan and how the policymakers are viewing it. And the second is a little more broad-based for the global South and BRICS. Over to you, Professor Arner.
Thanks for that, Malik. And once again, I think as Hin and Peter both said, you've given a very large number of questions there that probably could take hours and hours. And so what I'm going to try to do is I'm going to try to take
advantage of this, opportunity of having so many global panelists together. It's not every day that you get this chance.
I want to try to frame it first from the context of what we're seeing in the sort of finance technology regulation space, and then we'll move into the geopolitical directions. I think when I look at the big trends over the next 5 years in the context of finance, technology, and regulation, two of those are the transformation of digital assets into a regulated industry. And the second, which relates very much to that, is a real transformation in the way that we're seeing the evolution of cross-border money and payments. So if I want to frame first this idea of digital assets as a regulated industry, I think as Peter has framed nicely, in many ways, the US was the last major jurisdiction that was moving in this direction. And in many ways, what we're seeing the US doing now fits quite closely with what we're seeing a range of other jurisdictions, whether the EU, the UK, Japan, Hong Kong, Singapore, UAE, Switzerland, all of these, the framing of how that regulatory approach is starting to look quite similar. From an AML approach that we're now seeing the FATF enforcing against pretty much every country in the world, even China, which is taking a continuingly very negative approach, has had to change its AML laws to deal with the new FATF requirements. Secondly, around licensing, supervision, segregation of assets, and enforcement, all of these coming out of a combination of the ICO bubble and the FTX experience. The third, really from the standpoint of stablecoins legislation and regulation, which the initial impetus of this was really Facebook's Libra announcement in 2019, and an international process which is now coming into legislation which looks quite similar around the world. Now, if I want to frame this digital assets as a regulated industry, I think there are three pieces that are most interesting at this point in the time with the movements in the US. The first, as both Peter and Hen have framed, is the integration with traditional finance, particularly on the institutional standpoint. And what we're now seeing is an increasing range of tokenized government bonds, tokenized debt instruments of a variety of different forms. And the demand is for a high quality monetary instrument to embed in those, whether CBDC or some form of regulated stablecoins. And I think some of the interesting things that we're seeing a real pressure on is around tokenized money market mutual funds, tokenized funds, the ability to take traditional assets and put them in a tokenized form, and a very direct competitor, if you will, between, say, a tokenized money market mutual fund and a non-interest bearing stablecoin. I kind of know which one I would pick, but it's something that I think we're seeing this evolution in the market. Second piece, I think, is one of the most important, and this is one thing that we've achieved over the past 15 years is we've managed to build an infrastructure that connects about 2.5 billion people around the world. And if we look at the under 35 age group in a significant number of countries, including major economies like the UK, more under 35s have invested in crypto than traditional finance. Now, what that's saying is that we already have an age group across the world that is using this. The real challenge in many ways is getting them better products. And that is this transformation of digital assets becoming a regulated industry and the ability to begin to send higher quality products through that ecosystem. And I think this is going to be a huge story. That last piece is around stable coins. And this takes me to that sort of geopolitical area where we're having this combination between geopolitical developments and technological developments that are impacting cross-border payments in the international monetary system at a speed that I don't think we've seen since probably the early 1970s. And what I think we're seeing, certainly what I'm seeing in almost every country that I'm dealing with around the world, is an increasing desire to use their own currency in cross-border transactions. Now, the competition with this is that regulated major currency stablecoins, particularly US dollar stablecoins, will make it far easier to use the US dollar in transactions. And so you will have this sort of sometime later this year, as the regulatory framework in the States comes through and the licenses start coming through, you will have this very interesting competition between the products which make it easier to use the US dollar and the fact that you have geopolitics and other technologies that are making it easier to use alternatives. And I think as we look over the next 5 years, how this particular competition plays out is going to be tremendously significant. Now, there's one other aspect of that, and that is if we can see regulated US dollar stablecoins making it easier to use the US dollar, would it also be a situation where similarly regulated stablecoins from other major currencies would be made easier from the advent of stablecoins? And this is something where I think you have a number of governments are now thinking about whether or not they want to take that step to try to use the stablecoin structure as a way to make it easier to use their currency internationally and perhaps compete more directly from the standpoint of the US dollar. But the real challenge in many ways is that for the vast majority of countries, they don't necessarily want to replace the dollar by another currency issued by another country. They would prefer to find methodologies to be able to use their own currencies at a higher rate internationally. And I think this, from the standpoint of the technology, is a fact that the technology will make this easier. The geopolitics makes it more desirable, but the question is whether the ease and the availability of the dollar will do against this competitively. So I don't think I've quite covered everything you wanted, Malik, but that's a good start.
Thank you, Professor Arner. And again, I don't mean to put you in a spot, but you basically alluded to two forces largely working in a tug of war. One is the technology and the established payment system, and how US dollar stable coins will probably try to further the status quo or even enhance the dominance and hegemony. And on the other hand, emerging alternatives. And again, I keep coming back to the BRICS currency, because that's perhaps is one of the largest blocks of the global south. And we've seen a lot of new members getting added in the last at least a couple of these sessions. And there is a lot of talk about whether it is bilateral trade or even multilateral in this case, being done through a currency which can a payment system, a network which can entirely bypass existing systems. And again, perhaps that is why China has been working on the digital yuan for years now, well before anybody else even thought of a CBDC and a retail CBDC, so to speak, not a wholesale one, but a retail CBDC. So final question, and you can be very brief about it. I know nobody can see the future, but sitting where you are and with your vantage perspective, which of these forces do you see prevailing? Will it be the emerging geopolitical structural shifts? These are not cyclical shifts. I think we can all agree that these are now embedded as structural shifts, along with these new blocks of the global south and technology being established. And this is not just the BRICS currency. I think once Lito joins, we'll ask about the cross-border payment networks which are being set up in ASEAN as well, in Southeast Asia, whether it is the BIS's Project Nexus, etc. So these are happening wherever there are economic blocks and trade blocks. But if you had to put your money or make a prediction over the next 5 years, will the emergence of these alternatives, fueled by perhaps exacerbating geopolitical divergences, prevail, or will status quo through US dollar stable coins strengthen the existing bloc?
Yeah, thanks for that, Malik. And I think one can actually break it down into a couple of different pieces. I think for really middle-income countries and above, linkages between fast payment systems are probably going to be the central transformation in most individual regions. And I think what we're going to see is, in the context of individual regions, the combination of linkages of fast payment systems plus multi-currency platforms like the mBridge system that will make it easier to use individual country currencies in those regions. We can see this in the ASEAN context, we can see it in the GCC, we can see a variety of other regional efforts. And if one is thinking about ASEAN, for instance, how much sense does it really make to trade baht, dollar, rupiah, when you could just trade baht rupiah? And that's something that time-wise, distance, it's pretty logical. And I think as we see greater regional financial and economic activity in a range of regions, this sort of thing is going to happen. I think when we look at trade transactions, we're already seeing an alternative of other currencies used by major trading nations. And I would expect that on the trade side, this will continue. The key challenge from the standpoint of, if you will, challenging the dollar is actually from the standpoint of the liquid capital markets. And this is something where both China and the EU, for a variety of reasons, haven't been willing or able to take the step to create something that is equivalent to those US government capital markets. And so this is something where there are a very small number of potential countries that could do this. So this is something to watch. It is, however, the case that some of the activities in the US, some of the discussions around Mar-a-Lago structures, et cetera, could have a real push impact from the standpoint of looking at other liquidity pools as alternatives. And finally, I will flag that it could also be the case that the new money is the old money. Gold is everywhere. We're seeing gold used increasingly by everywhere. And if we look at the history of human civilization, far more often than not, that's been our base monetary instrument. So the thing that I'll leave you with is the more difficult the geopolitics get, the more I see us moving back to old technologies rather than some new geopolitical alternative.
Interesting. And I was at a conference way back in, I think, 2017 or 18, organized by the ADB. It was a central bankers conference where I heard many of these central bankers talk about increasing their focus on gold. And this was about 7-8 years back, even before COVID. So I was like wondering, why would they want to move away from treasury bills, etc., which are liquid instruments, back to a more middle age kind of a thing. But now I think it makes sense, and we've seen gold hit a record high. So that again, I think the market sentiment also drives this. So thank you for that. And I think one of the things that you touched upon was this thing of dollar versus local currency stable coin. So with that, I'll take the opportunity to go to Maha, who is an expert from the MENA and the GCC region. And Maha, pleasure to be with you again on the panel. Lovely as always. We will, ask you about Qatar, of course, specifically, but also the GCC and the MENA region more broadly, if you're comfortable answering this. We've heard from the other regions on the impact of these developments, these announcements, and what is expected from the US. How does QFC view these developments, and accordingly, what is your strategy? How is it evolving? How is it unfolding, or is it pretty much in line with what you were doing before, Jan 20th? And again, if I may ask you multiple questions, what would be the impact of these on three key aspects? Because I think these three are important to Qatar, and from a regulatory perspective, QFC would probably be focused on these. One is, what does it mean for USD stable coins versus stable coins in Qatari Riyal? Second is, and again, this may be a slightly politically tricky point, but before these announcements, there was a lot or a fair bit of regulatory and jurisdictional arbitrage. So we saw quite a few companies where they were not getting what they perceived as fair treatment, moving to other more friendly jurisdictions, and Qatar was definitely one of them. And I've interacted with QFC, so QFC has been really promoting itself as a welcoming and a more rational jurisdiction. So that's the other part of it. So jurisdictional arbitrage, that's the other thing, and how QFC has been driving friendly policies. And the third, of course, which is a topic close to my heart and close to our heart at GIFT, which is financial inclusion and digital financial inclusion. Qatar, of course, like many other countries in the region, has a lot of migrant workers, many of them blue collar, and for whom, as Professor Arner touched, the speed and the cost of these cross-border remittances really matters, because they are not doing millions of dollars in flows. They are probably sending $500 home every month. So every $5 shaved off makes a big difference to them. So if you can touch upon these three things, one is stable coins and QFC's view on stable coins per se, and whether USD will be preferred or will it be a move towards local currency as we are seeing in some other jurisdictions. The other is, what does it mean for jurisdictional arbitrage that Qatar has built over the last few years. And the third is digital financial inclusion. Over to you.
Absolutely. First and foremost, thank you so much for the opportunity to be here amongst some of the best speakers that I know. And I love the fact that it's super multinational and multi-jurisdictional, which gives it a very important flavor. When it comes to Qatar, Qatar has decided to always have a very cautious approach when it comes to cryptocurrencies, but it was always very welcoming when it comes to the adoption of new technologies. So when we looked into it, we always welcomed blockchain and DLT as an underlying technology for any sort of use cases. But where we were very strict and careful was looking into how cryptocurrencies would evolve. And going back to some of the points that were mentioned earlier, particularly by Peter, we felt like the best use case would be to tokenize real-world assets, specifically what we refer to as investment tokens or security tokens, because we think this will be an excellent use case that would enhance market efficiency, transparency. I've seen it in a previous life during my tenure at Deutsche Börse D7, where we looked into the dematerialization of securities and issuing bearer bonds digitally. So that was really the focus that we had: welcoming technology, welcoming use cases that would scale and would still exist without any sort of speculation or constant change. When we look into our neighboring countries, I think the United Arab Emirates has been taking a different approach. We know that the UAE has the first digital asset regulator or virtual asset regulator for accuracy, VARA. ADGM recently welcomed Circle, DFSA, and they also have Ras Al Khaimah for their other digital assets, Oasis. So the UAE took a different approach. So I do not really see that there will be any sort of regulatory or jurisdictional arbitrage, because the UAE was very much cryptocurrency, stablecoin focused, whereas Qatar chose to have more real-world asset tokenization / investment tokens focus. Additionally, there is another thing that makes what Qatar Financial Center doing a bit more unique to its peers, and this is not meant to be as a marketing pitch. The fact that we are an onshore jurisdiction, we're based on English common law. We have our own court, and we have also introduced our own digital asset lab to test these things. And we decided to be very, very clear into when the use of technology does not require any interference. If you're using blockchain DLT, I don't know, for automating processes, we're out. You can register your firm and license it. But the moment that you're dealing specifically with client money and having any sort of financial interaction, it's very important to make sure that the right guardrails and consumer protection is installed. And that's where we have our digital asset lab. We're working very closely, not only with Qatar Financial Center Regulatory Authority, but also with Qatar Central Bank and Qatar Financial Market Authority to make sure that within the state of Qatar, everyone is aligned. The second point that you mentioned has to do with stablecoins, and if it's going to be US-backed stablecoins or local-based Qatari riyals or other currencies. Qatar has been also looking at the developments very closely. We also know that for any tokenization framework to be successful, we need to look into the on-chain and off-chain trails. We have to make sure that there is cash on ledger in a way, be it digital or not. And we are also expecting the Qatari Central Bank to come up with a progress report on its wholesale CBDC project. If it's local or US dollar, I think this is going to be part of the Qatari Central Bank's assessment. And of course, the recent changes in the US has been paramount for these considerations. We have also been closely studying the developments and the papers that were issued by the BIS. We did not expect the Uno reverse card when it came to mBridge, because we were looking at it very closely, and all of a sudden when mBridge was stopped and everything was sent back to the central banks, that was also an aha moment for us. It's like, okay, maybe slow and steady is the right approach after all. So this is something that has been really a focus for us. Again, if I want to have a look at our regional players or our neighboring countries, I recall, if I'm not mistaken, 2 days ago, the there's a bank in the UAE, I think it's called FAB, in Abu Dhabi, that announced that they're working with the United Arab Emirates Central Bank to issue a dirham-based stablecoin. So maybe the UAE will be taking a different approach, similar to what Mr. Douglas has mentioned earlier. Are we using our own currencies, which, from a geopolitical point of view, could be an issue steering toward de-dollarization, because for a very long time we did not have that regulatory clarity from the US, and now that we have it, do we use our own currency, or could we just peg on the dollar, which is by far the biggest currency there is for remittances, for settlements and clearing? We also see that Circle has also recently announced that they will be having a payment license by ADGM in the United Arab Emirates. When it comes to Jordan, where I come from, I know that Jordan recently also announced their the virtual assets framework. They are looking into stable coins. They're still in a discovery mode, but Jordan is one of the countries that are also very heavily dependent on remittances in or out of the country. So I think it's a time where we have to see, time will tell, because we need to make sure that what we're building is built on, if I may, solid foundations, and that it will not change after the next 4 years of the change of administration, because you never really know if how things would change. It's done on a federal level, and I do not know who mentioned it. I think Chen mentioned that the fact that it is done on an executive level, but we need to see how the different administration would work on it. I personally found the withdrawal of certain guidances by the Fed last week paramount to that momentum that we're looking for when it comes to withdrawing from guidances for banking crypto asset service providers, adding liquidity. I see this as a bit of a cautious development that is also welcome, where we're having more institutional players adding to that, which could make it more difficult for smaller firms and startups to keep up the pace with. Again, regulation matters. And previously, when we used to look at the industry from 2018-19, all of the crypto asset service providers were trying to be like allergic against regulation, but now they're begging for it to be able to get the credibility and the market access. And I think this will also enhance the role of institutional players and banks, including who we try to keep out of the picture, securities depositories, where they will have to reinvent themselves in a way. Conscious of the time, and I don't want to step over the time that's allocated, the final point, which is financial inclusion, this is exactly the reason that I went into that industry to begin with. Sadly, there's two sides of the coin. The first side was a lot of people went to it thinking about financial inclusion, but there was a lot of fraud. There was a lot of ways where people would think that they're going into stablecoins and cryptocurrencies to enhance financial inclusion, but there were a lot of bad players. We all know what happened with FTX, with Terra Luna, etc. When it comes to Qatar specifically, I cannot speak for all of the other regions. I have to say, seeing it firsthand, there are a lot of very effective, very, very cheap remittances opportunities that can help migrant workers send money back home. It is actually one of the pillars that Qatar has set for itself in its third financial sector strategy and the Fintech strategy for the next years, so to be materialized maximum by 2030. Financial inclusion is one of the main paramount focuses that they have in there. So we do not necessarily need, let's say, a crypto or stable coins for that, because there's a service that is called Fawran, for example. All you need is a phone number, and it's sent instantly with a very, very, very minor amount of transaction fees. We have in our region also the role of telecommunication providers providing ways to also telecommunication providers have the technology plus the payment licenses from the central bank, and they're enabling very cheap remittances back home. However, looking at what, for example, Jordan and Egypt has, I know for a fact that they were working with Ripple for that, for some of these use cases, etc. So I see remittances and financial inclusion as paramount, but currently there are also other use cases that does not necessarily require crypto or stable coins. But of course, the moment that we have more maturity, more demand, and we also need to make sure that people who are affected by the financial inclusion, so they're not, I don't want to say that they're financially illiterate, they still need to understand the risks associated with that. And there is a moral obligation for us to make sure that once we adopt it, they are aware of the risks and they are also having the right consumer protection mechanisms in place, because for them, honestly, every penny matters. So I'm cautiously optimistic. Maybe because I had a lot of hopes, but it started with a meme coin. But okay, now we're going for more regulatory clarity and a lot of regulations that will, whether we like it or not, determine where things are going. But finally, I would conclude that we have to look at everything from an international standard setting body point of view with principles and standards. And there, I would have to admit that I'm more lenient toward what Europe has done with MiC and the DLT pilot regime, because I feel like it's more in line with IOSCO, FSB, and BIS standards in general. Of course, there's always room for improvement. But personally, whenever I'm looking for a parameter, I would be more lenient toward the EU when it comes to that regulatory clarity and next steps that we would like to pursue in our region. Thank you.
Thank you, Maha. And, I'm glad that I have a fellow protagonist and someone who's as passionate about financial inclusion, digital financial inclusion. That was one of your key drivers for taking up this role. Again, I'll say something which may not be music to everybody's ears in the ecosystem, but you alluded to the role of telcos. And again, it almost seems like, Back to the Future, one of the first successful digital financial inclusion experiments or pilots or projects which really became scalable and successful was M-Pesa in Kenya. I'm sure all of us have heard it. At the same time, GCash and Smart Money in the Philippines, which has now become Maya. And they are the two largest wallets in the Philippines, far, far, far larger than any of the established or mainstream financial services players. And of course, Professor Arner is here. So how can you talk about digital financial inclusion at scale without referring to Alipay and WeChat Pay, 1 billion customers? I don't know if any of the stable coins will ever get to that point or when they will get to that point. And if I had to, again, very brutally compare and contrast, you have FTX on one hand and the so-called algorithmic stable coins. Again, that's a discussion for perhaps another time or when we get together on the next panel. But relying too much on technology or algorithm or programming as law, which was the mantra of this industry before some of these busts happened. And on the other hand, you have telco players who are leveraging their scale as well as their established knowledge to bridge this gap between financial exclusion for even simple things like remittances, where it was expensive and it was, there were a lot of time delays, to bridging that in such a seamless manner. And look at how all these players have driven financial inclusion. None of them is a financial entity. And then now, of course, they've all gotten licenses from the central banks. But perhaps there's a lesson for our industry and our ecosystem. It's not about the next shiny thing, but it's about, as you said, Maha, building something fundamentally with strong foundations. So thank you for articulating that and helping us conclude this discussion on a note which is very close to my heart. We have one question from the audience, and I'll place it there. So if anybody wants to answer it, please go ahead. This is from Manolis Arvanitis. I hope I pronounced your name correctly. So please don't mind if I have not. And HCMC, so I'm assuming you are from Ho Chi Minh. The question is, from the discussions that have taken place so far, to which extent do you believe that the new US approach may challenge recommendations set out by IOSCO for digital assets and DeFi, and in particular, the overarching principle, I like this question, of same activities, same risks, same regulatory outcomes? Anyone would like to take that?
Well, maybe I can say something on that, because I recently did a post on that also. Because if you work in the fintech area, it's a very popular thing to say same activity, same risk, same regulation. But in reality, this has turned out to be a bit of a policy and legalistic platitude, which is often used to avoid or to hide behind or to avoid doing anything. Because if you look at financial technology, and it can be blockchain, can be DLT, can be AI, can be all kinds of, all of them together, is that often because the technology stack is fundamentally different, the activity isn't the same, or the activity is carried out in a very different way. And therefore, the closest you can come is, well, maybe it's the same economic function, or maybe it's the same outcome, but it doesn't mean it's the same activity. And I sometimes compare this to traveling. You can go on foot from one place to the next. You can go by bike. You can go by car. And if it's long distance, you can take a train or a plane. Now, the activity or the outcome is the same. After the travel, you're in a different place. But no one would say that because you ended up in the same place, that going on foot or going by bike or going in a car is the same activity and therefore should be governed in the same way. And what we see with blockchain DLT is that, yes, the outcome, it may be the same, the economic function may be the same, but the activity is very different. The tech stack is very different. And therefore, I think that the policy and regulation should be different or should be adapted to that, because all the regulation which I'm familiar with, and I'm only familiar with a fraction of the regulation that exists, but in the regulation I come across, I have yet to see a piece of legislation or regulation that is truly technology neutral. All of the regulations reflect and assume the state of the technology and the dominant design of the technology at the moment the legislation or the regulation is enacted. And often you see that the legislation, although it aims or pretends or assumes it's technology neutral, it isn't, because it assumes that the economy or the businesses pursue a particular model and are organized around a particular tech stack. And if the technology stack then changes, the regulation becomes ill-adapted to the new environment, because it raises questions, or it requires a kind of compliance that is almost impossible, if not completely impossible, to achieve in the new environment. So therefore, I think that we should, for everyone who is involved in innovation and promoting innovation, we should try to stay away from this mantra, which is, in my view, and sorry to say so, a platitude of same activity, same risk, same rules, because it just doesn't exist. Thank you.
Thank you, Peter. And before I give my 2 cents on this, anybody else wants to add to this?
I would just say it's same, but different. So you can't really, they might look the same, but they're always different.
I will throw in one thing that I think is interesting in the US context at the moment. The approach is not one of not regulating these or not enforcing. It's of developing a clear regulatory framework, which is relatively equivalent to other sorts of regulatory frameworks for regulated portions of financial services in the United States. This is about bringing crypto and digital assets into the regulatory framework as opposed to making them unregulated. And I think this is something that in some ways is perhaps, some might think this is unexpected, but that's the approach that the administration has fully adopted. And I think that that's a very important place to start.
Thank you, Doug. And I think if I were to give my 2 cents, hearing all the 3 of our panelists here, there is always this ongoing challenge and dilemma, right? Especially for those who are regulators like Maha, on where is the right equilibrium? Because per se, by definition, policies, regulations, laws will always be trying to play catch up with innovations. That's just the nature of innovations. They are always at the leading edge of the curve. So do you try and superimpose what is there and say, hey, look at the macro framework and try and plug in with whatever we've created for securities laws or commodities laws, or how tokens will be defined or categorized? Or do you put in effort to create customized regulations, policies, even laws, only to realize that the industry has moved forward to the next stage? So it's never an easy thing. But thank you all for giving your perspectives. And finally, in conclusion, I want to give a shout out. There was a comment here, audience comment, to my good friend and our GIFT South Asia chapter co-lead, Neera, who's here in the audience as well. She's mentioned, and I actually wanted to mention this as well. We spoke a lot about real world digital assets, and they have done tokenization of real estate in India. So this is not just a pipe dream, or this is not something theoretical. We have someone here in the audience, and my good friend. They are doing it. And again, I have had extensive discussions with them, not just on the opportunity, but also on the significant challenges, how to marry real world with tokenization, including the various regulatory layers which come in. But that's again a discussion perhaps for our next conversation. So being mindful of time and the fact that unfortunately our last panelist, Lito, is stuck with the BSP and the regulator, so he's unable to join. We will conclude the discussion here. From my side, a big thank you to all the panelists for generously and very candidly sharing their knowledge and their perspectives and helping us bring learnings from so many different parts of the world. With that, I turn it over to you, Yorios. Thank you.
Yeah, of course. Thank you all for your very valuable insights and for the very interesting conversation. It has been a pleasure to have you here with us here today. So yeah, we look forward to continue the conversation. Of course, once again, we will upload the recording of this particular webinar to our social media in the coming weeks. So for all of you that you want to rewatch or those who missed it, thank you so much once again for being with us.
Thank you.
Thanks, everyone.
Thank you.
Bye.
Bye.
Bye-bye.